Good afternoon, everybody, to our webinar this afternoon. I'm delighted to be joined with David and Simon from BP Collins in Jerry's Cross. And today's webinar is looking at directors' duties and obligations in these challenging times. We're going to be looking at key issues to ensure compliance with duties imposed by company and insolvency legislation, and even what a director can do to avoid possible future litigation should a company not survive and enter into liquidation. Welcome participants. I can see we've got quite a few with us. Thank you for joining us. My name is David Saab from the Thames Valley Chamber of Commerce. Proud to be representing the Chamber today. If any of you have questions as we go along, may I invite you to use the chat facility, and there will be a Q&A session towards the end, unless my my comrades would like to answer any particular pressing question during the presentation. We are on a fairly free flow situation, and look forward to any of your questions. Without further ado, I'd like to hand over to David and Simon to introduce themselves. Over to you, chaps.
Thank you. It's David Smiley here from BP Collins. Firstly, my apologies. Technology seems to have failed me straight away. I don't know whether, David, can you see if you can move the slides on, because it's not having any effect for me. Just to try and get through the slides, and apologies for that. Oh, and again.
There we go.
Great. And probably one more. If I just say, David, if you've obviously got it to work, so I'll just shout when we need to turn the page. So as I say, my name is David Smiley. I'm a corporate partner at BP Collins. I've got 20 plus, regrettably, it's probably closer to 30 years now, transactional experience. I advise boards, directors and owners on structuring, complex structuring, duties and obligations. And regrettably, I've been through 2 recessions. So I've had to turn my hand to insolvency advice and advice to directors. And I'm joined today by Simon, and I'll let Simon introduce himself.
Oh, good afternoon, everyone. It's great to be here. My perspective is a little different to David's, but we overlap. I'm a litigator and a solicitor advocate. My, I suppose, area of expertise is typically litigation, arbitration. I tend to advise on commercial and finance dealings, all sorts of shareholders and director disputes, and insolvency bits in connection with asset recovery. So whether it's shareholders in unfair prejudice actions or directors in disqualification proceedings, that's usually my area. And so what I'll be talking about today with David is the relevant bits. Yes?
If we can go to the next page, David, that'd be great. Thanks. So I think I'll just put it into context, and then I think Simon will take us through what we are going to discuss. So I think in context, clearly we are, without wanting to dramatise the position we're in, it's probably true to say that there are profound business interruptions, which has led many previously healthy businesses to consider their ability to continue in business. Coronavirus is presenting a novel situation, both for businesses, individuals and governments. But that novel situation is having a significant impact on trade, and it's testing, and will continue to test for the foreseeable future, the viability of many businesses. I suppose we could say that we've been here before, maybe not this scale, maybe not this way, but as I mentioned at the start, there's been the recession in 2008-9, there was the recession in the 1990s. Same sort of guidance applies, different legislation, but same sort of guidance is applied then. Just first thing to say is these rules apply whether or not we're in a difficult period like now, or whether we're in a boom period, they're the rule book, that's where we've got to go. The different situation that we've got at the present time is the scale of government intervention. The government has specifically stated its intention of trying to alleviate trading concerns for businesses. So we've got the Corona Business Interruption Loan Scheme, to the extent people can get hold of that. We've got the deferment of payment of taxes. There is going to be, we are told, the suspension of wrongful trading provisions, and that's something we'll come on to later. There's also going to be new insolvency law reforms, which are going to be introduced. And again, we'll discuss with that later. Simon, I think, will then take us through what we're actually going to discuss today.
Yeah, so what we're going to talk about, and what David and I think is going to be most helpful is firstly just to set out some ground rules. It may well be things that you know about, but corporate veil and directors' duties, what they are, how they apply. We're then going to look at very broadly what happens when insolvency concerns come to fruition. We're going to look at the main tools liquidators have to look back at actions taken by companies at the director's instruction. And the main thing we're getting across here is that the intention is to recover money when circumstances allow it. And really, it's a case of knowledge is power, because the more you know, the better prepared you'll be able to be. We're going to look briefly at director disqualification and how that works, and when you need to be concerned, I suppose. And then we're going to look at some practical guidance, which really draws together what we see at the moment and how we think it's best going to sort of help you on a practical level. Just a couple of sort of headline notes. David and I are solicitors in England and Wales, so we're talking from that perspective. The second thing to bear in mind is that each and every situation differs, particularly from my perspective when we're dealing with claims. They often have similarities, but each of these situations tends to need to be looked at in its own light. So our aim today is to talk through trends and to provide you with some general information that we think is going to help, but it shouldn't be treated as legal advice in its own right. That said, we're very happy to help and talk about specific situations directly. So please feel free to get in touch if you want to do that.
Okay, I think as Simon sort of alluded to there, the key point is that the company is a separate legal person with its own agenda. We often see, particularly for smaller companies, directors or shareholders who treat the company's assets as their own assets. So you end up with a company making payment for personal cars, personal expenses, personal airfares, whatever. In good times, yes, that is technically unlawful. It shouldn't be done, but that can normally be reconciled by an accountant at the year end. No real impact follows from that. The difficulties which can arise is when a downturn hits, because those acts, paying for a personal holiday, paying for personal expenses, can be acts which can prejudice the company and its creditors, and that can result in problems for the directors. Having said that, we've always got to remember directors, particularly of startups and SMEs, are going to be heavily invested in their companies, either personally, financially, or both. And they face a lot of pressure, both to build that business and push it through, but also to keep their own life going. However, that's got to be done within the rules. If people have chosen a company as the vehicle to trade with, they've got to stay within the rules of operating that company. So the Companies Act 2006, sections 171 to 177, that codified many common law and equitable duties for directors. The ones that you can see on screen are the 7 which are actually named in the Companies Act. Those are directors' duties. Those duties are owed to the company of which the person is a director. Those duties are not owed to other group companies. They're not owed to individual shareholders. There's some slight differences in nuances if the company may be insolvent, and that's something we'll come on to discuss later. And the important thing is these duties apply to all directors, whether you're an executive director, a non-executive director, a shadow director, a non-executive chairman. Just because you're not a day-to-day director, these duties will apply to you. So just going through these 7 different ones very quickly. So the first one, you've got a duty to act within the company's powers. That's really looking at the company's constitution. What powers do the Articles of Association confer? Are there any limits to those powers? How are the decisions to be made? The important point is don't abuse the rules which are laid down. Use the resolution and minutes which are required to evidence that you follow the correct process. That could be very important in the future. And I know it's one of the sort of takeaways that I think Simon and I will want to leave you with, which is you need to make sure that the reasons for making decisions are well documented. Perhaps the most important in the current climate we're in is the duty to promote the success of the company. Now, that is a duty which the directors must act in the way that they consider in good faith is most likely to promote the success of the company for the benefit of its members as a whole. Now, again, as we'll touch on later, that changes in the insolvent situation. The Companies Act actually set out the factors which have got to be considered, which include but aren't limited to the following. That's the long-term consequences of any decision that you take, the interests of the employees, the need to foster business relationships with suppliers, the impact that any decisions may have on the community or the environment, the desirability of maintaining a reputation for high standards of business conduct, and finally, acting fairly between members' interests. Now, as I say, that is not an exhaustive list, but that's the list that the legislation decided should be actually set out in the Companies Act. Then there's a duty to exercise independent judgment. And I know Simon may have a point on this, but that's the director should try not to fetter their discretion. You shouldn't be entering into shareholders' agreements, for example, where it says, I will always vote against a particular resolution. That could cause problems.
Yeah, it's something that comes up a lot, particularly when thinking about conflicts of interest, and we'll touch on this a bit later, but an interesting case example that we can just sort of highlight very briefly is one of the sort of well-known domestic flight companies, EasyJet, has, like many businesses in that sector, is looking ahead at concerns around its fleet being grounded. It's got a contract to expand its fleet, another 100 or so planes due to be paid for between 2020 and 2023 at a cost of around $4.5 billion. Now, the point here is that, and you may have seen it in the media, one of the majority shareholders wrote to the board an open letter saying, look, this is absurd. You need to get rid of this contract. The value of this dwarfs the company's market capital of 4 billion. But the way in which he went about it was to say, look, if you don't do what I want, what I'm suggesting, I will call a meeting at which I will consider terminating each of the directors one by one until you do what I want. Now, it's relevant because the point may be commercially sound, and I think the board of directors are dealing with the matter appropriately. But what one can't do clearly is just bow to external pressure, because the directors have a duty to the entire company to exercise independent judgment, to not be swayed by things like that. And it's a really interesting example, in a tight commercial situation when investments are going to be a concern for shareholders. What sort of influence can they expect to impose on boards, and to what extent should directors in those positions be listening to or dealing with those considerations? Just an interesting one to pick out. David, back to you.
Yeah, so
David,
there's a duty to exercise reasonable care, skill, and diligence. Now there's an objective test and a subjective test there. So it's the care, skill and diligence that a reasonably diligent person with the general knowledge, skill and experience reasonably expected of someone doing the work of that director would have. That's the objective test. But also the actual general knowledge, skill and experience that the director has. The point here is that if someone is, for example, a financial director, is a chartered accountant and has got great experience, that person will have a higher duty than someone else who doesn't have those skills. So specialist knowledge will lead to a higher burden there. There's a duty to avoid conflicts of interest. Now that, again, can be very relevant. You've got to be careful if you're in a group of companies or if you've got family members. If you're involved in either of those situations, the decisions you're making should be decisions for the company, not the group as a whole, but decisions for the company. So why are the decisions you're making right for the company? There is a duty not to accept benefits from third parties. Benefits aren't defined, but that would need to be regarded as something likely to give rise to a conflict of interest. And finally, there is a duty to declare an interest in proposed transactions. All these you will have come across in the general backwards and forwards of corporate exercises. Board minutes are produced, you refer to board minutes, you normally say having taken into account the obligations in section 171 to 177 of the Companies Act. It's more and more important that people actually look at these and make it clear why people are making the decisions. I think, again, something to take away from here, I think what we're saying is that it's important to remember that when you're making decisions, you may well be wearing different hats. What's good for you as a shareholder may not be what's right for the business. What's right for you as an employee may not be right for the business. And you may end up with a conflict between what you should be doing as a director, what you really want to do as a shareholder, and the obligations you've got as an employee. And I think that's, unless Simon, you've got anything else, I think we can go on to the next slide.
Can I just interject there briefly, chaps?
Yep.
Going out to all participants, those of you that joined us a little bit late, encourage you to use the chat facility to ask questions. We'll be holding a Q&A at the end. Okay, chaps, on you go.
No problem. Well, if I can just jump in briefly, because it's worth saying at this point, one thing, bearing in mind that a lot of my role involves looking backwards in time at these sorts of decisions, and one thing it's worth thinking about is how these decisions get documented, because if litigation arises later on, then directors are in a much better position if they can provide records, for example, minutes of discussions to show that they paid due regard to the relevant factors when they were making their decisions. And although each situation is going to differ, and I think it's fair to say the prevailing view is that it's sufficient for minutes to explain that directors have taken these things into account in carrying out their duties. But if any factor is particularly relevant, and this really becomes key when you're looking at solvency issues, whether or not it's in the list that David ran through earlier on, it's really sensible for the minutes to reflect those points, because it's a piece of evidence that you can pull out later down the line to say, look, liquidator, this is why the decision was appropriate. This is why there wasn't a problem. And I should say that the more significant the decision, or the more controversial, the more advisable it is for there to be some very clear piece of evidence. It's not always worth briefing papers being written, but in some cases it is just something that allows us to have some evidence to help you later down the line is quite crucial.
Sort of continuing on that point, sorry, it's try to make those as contemporaneous as possible, those notes. no point trying to rewrite history in 6 weeks' time and saying, I'm sure at the meeting that we held on the 7th of April, we did discuss this, didn't we? If you can try and make them contemporaneous, it will hold more weight going forward.
Yeah, absolutely.
So I think we're then on to the why it's important. I think, Simon, you were going to start off, I think, on this, weren't you?
Yeah, so the big point here is that all of these things create liability for directors. Now, as David said, the duties are owed to the company, and therefore the company to enforce them. Now, although in certain circumstances shareholders can bring what's called a derivative action on the company's behalf, when there are, for example, breaches of general duty rules by the directors, including things like the requirement to exercise reasonable care and skill. The key point that we're making is that the company will have a cause of action, so a right to sue the directors for breaches of these duties. And that's relevant when control of the company switches to an administrator or a liquidator. Now, the remedies for these claims are almost always damages, but they can include things like an injunction or setting aside a transaction that's taken place, count of profits, or restoring property that belongs to the company that is in the hands of a director. And they can also have an impact on sort of executive director service contract. Now, in terms of relief from that liability, David, was that something you were going to talk through in section 239?
Yeah, I mean, you can get relief, and we can both jump in. I mean, the company can ratify and condone some of the director's conducts. So section 239 of the Companies Act specifically allows that. The court have actually got power to grant relief in certain circumstances. That provides that where proceedings for negligence, default, breach of duty or breach of trust are brought against directors, the court can grant relief from liability if it considers, firstly, that the directors have acted honestly and reasonably, and secondly, considering all the circumstances of the case, they ought to be fairly excused. But that is a fairly exceptional, although everyone tries to run that as an argument as to why proceedings shouldn't succeed against directors. I think it's exceptional for that to succeed. The other mitigating the risk to an extent is to think about, have you got directors and officers insurance? I'm wondering the extent to which it is now available, or the premium that may be charged. If you've got existing indemnity and insurance directors policy, then that can cover any costs that may be involved in proceedings that are suffered by the director, provided that they are successful. If the director is unsuccessful in any of those actions, so the liquidator or the administrator is successful, then those costs are recovered from the director.
Should we go to the next slide?
Yeah, I think we can go to the next slide. So if I just deal with the first, and then we'll come on to Simon, we'll take over. Clearly the position at the minute, and the question is a company insolvent? And as you'll see when we go on in this discussion, the duties and obligations when a company becomes insolvent change. The obligations change so that you should be looking after the interests of creditors as a whole rather than the company. In this particular scenario that we're looking at, I think you would say that probably you're looking at a cash flow insolvency. That means a company will be insolvent if it cannot meet its debts as and when they fall due. And that is a situation where a lot of companies will actually find themselves at the present time, particularly if their customers are ceasing to pay them, but they have got bills to pay. They have got their employees to pay. Have the loans from the government come through? Have the loans for furloughing come through? all of that could mean that a company is technically insolvent. The problem we've got, and because of the various loans which are available, I think there's going to be significant uncertainty to any assessment by directors about their company's solvency. And I think this is, again, another reason why directors should be recording why they believe in any particular, at any particular time, that could be daily, that the company is at that stage solvent. That should be recorded so that you can come back and see, because on the 7th of April, we looked at this, we looked at that, and it's all set out, and that's why we still believe the company was solvent. That is going to be evidence going forward. Simon, I think you're going to take it forward as to what happens when it possibly does become insolvent.
Well, I think we start with the rules, the director's duties, because I think the big point here is that all the duties directors owe still apply, and for example, the obligation to promote the success of the company. Now, that's something we'll touch on in a second, but the Section 172 duty to act in the interests of the company's members, shareholders, is displaced with a duty to act in the best, well, not in the best interest of the creditors, but to consider the interests of the creditors when the company is insolvent. Now, or when it nears insolvency. Now, the provision in the Companies Act is drafted in a way that's intended to allow case law to develop, so to allow judges some freedom to make decisions on a case-by-case basis. But the old common law rule still applies, which is that where a company is insolvent, the director has to consider the interests of the creditors, not just individual creditors, but creditors as a class. And that obligation is really, really paramount. And this is the area where we see I suppose, by far the biggest number of problems. So when the company is insolvent or nears insolvency, or is in a position that leads someone reasonably to think they're at that stage, you have to take those interests into account when carrying out your duties as a director to the company. It doesn't, we could go into some detail talking about how that rule has been expressed in various different cases. Whether you say, well, the company was of doubtful solvency or on the verge of solvency, I think that the point is that at that point in time, there is a switch and the obligation moves from an interest owed simply to the shareholders to one more broadly owed to maintain assets of the company for the benefit of creditors. Now, the problem there is for directors and shareholders is often that things happen, money is transferred, and this is an area that leads to claims that we'll touch on. But I suppose the big practical consideration in today's terms is, when does the duty switch? And the answer is there's no precise point. It's not clear. We fall back to case law, and it's been said, for example, that it's clear that an established definite insolvency before the transaction is not a prerequisite. The underlying principle is that directors are not free to take action which puts at real or as opposed to remote risk the creditor's prospects of being paid without first having considered their interests. Exactly when the risk to creditors' interest becomes real for those purposes will ultimately have to be judged on a case-by-case basis. Now, I think that's as far as we get, but it does give us a fairly big indicator, I suppose, as to the elephant that is in the room. And I'm sure it's something that many directors will already be aware of. The real issue is I suppose, recognising it as a risk and knowing what to do about it. The duty itself, if one breaches that rule, it's actionable at common law. which is simply another way of an action being brought against a director, in addition to breach of a statutory rule. Now, one thing that you'll have heard quite a lot about in the press is wrongful trading and fraudulent trading. Wrongful trading in particular has been talked about quite a bit. The reality is both of these are quite rare as causes of action. And I suspect much of what we hear in the press is, I suppose, canvassed with a degree of political oversight. I think the reality is the suggestion that a removal of wrongful trading provisions having a significant impact for directors is probably not brought out when one looks at the breadth of facilities that liquidators have to recover. They're very rarely applied, and it's likely that very little that could be claimed under a wrongful trading action couldn't also be claimed as a simple breach of directors' duties. But it's worth that we just spend a little bit of time talking about them, because as many of you will be aware, we have section 213 of the Insolvency Act, which is largely geared to fraud. It says that if in the course of a winding up or an administration it appears to any business, it appears that any business of the company has been carried out with the intention to defraud creditors or for any other fraudulent purpose, a liquidator or an administrator can seek a declaration from the court that anyone who was knowingly a party to the business make a contribution to the company's assets. Now, this is an application that a liquidator or an administrator can bring. It's very broad, it applies to anyone, not just directors. An order can be obtained for any contribution as the court thinks proper. So the recovery is paid into a general pool of assets that are available for distribution among the unsecured creditors. So as you'll see, it's very wide, it's geared to fraud, and proving fraud is a very, not impossible of course, but it's a high burden to get over. And as I say, it's not something that we see in sort of everyday circumstances. The wrongful trading aspect, section 214 of the Insolvency Act, is that if in the course of an insolvent winding up or an insolvent administration of a company, it appears that a person who is or was a director of the company knew or ought to have concluded at some point before the commencement of the liquidation or administration that there was no reasonable prospect that the company would avoid an insolvent liquidation or an administration, the liquidator can seek a court declaration that the director make a contribution to the company's assets. So this is applicable to any person who occupies the position of a director by whatever name. So whether you're in law treated as a shadow director, a non-exec director, or whatever, it applies. Liability only arises if on a net basis it's shown that the company is worse off as a result of the continuation of trading. And this is really what makes it difficult to prove. The court's not going to make an order if, knowing that there was no reasonable prospect that a company would avoid insolvency, a director took every step with a view to minimising the potential loss to creditors, as he ought to have done. And what has to be shown is that in practice, a significant amount of work usually needs to be put into establishing what might have happened and what caused the insolvency. And I suspect that it's one of these reasons that leads to the number of these sorts of cases being fairly limited, because liquidators have a very defined pool of assets. They have the money that the company has, and there may in some circumstances be lawyers who will fund that work on a contingency fee basis, but the reality is they often don't want to invest vast amounts of money in pursuing claims that are difficult to prove. So they're more likely to pursue more simple actions, such as those for misfeasance under section 212. Now, this applies to situations where, if in the course of a winding up, so a liquidation, it appears that any present or former director has misapplied or retained or become accountable for any money or other property of the company, or if they've been guilty of any misfeasance or breach of any fiduciary or any other duty, the court may order the director to repay or restore or account for that money or property with interest, or to contribute in such sum by way of compensation as the court thinks fit. This is a much, much wider provision, and the hurdle to prove it is much lower. What we tend to see is that the majority of claims are made under this head, and as you'll note, it applies to any present or former officer of the company, and any person who is or has been concerned or taken part in the promotion or the formation or the management of the company. So it really is very wide, and the definition of a director includes any person who occupies that position, regardless of their name. So it's intended to catch quite a large amount of conduct. We're going to talk briefly about personal guarantees. David, I'm not sure if that's something you wanted to pick up on.
Yeah, I can do. I mean, many people, particularly directors of smaller companies, will be aware that in the past, banks have been reluctant to lend unless the directors also give personal guarantees. That is the unfortunate reality. Clearly, with the new interruption business loan scheme, there's been pressure from the government not to require those personal guarantees. I think all that the banks were doing, to be fair, is the banks had been told you must apply normal lending rules. The normal lending rules were we would normally expect a guarantee from a director. So undoubtedly there will be a lot of situations where directors, in order to get their basic business banking finance, have given personal guarantees. Those are normally drafted very strictly in favour of the bank or the lending institution, and they will be in situations where if the company owes any money and it is not paid, the bank can come across against the director personally. Now, if that director has assets, the bank will come against that director. That is the simple factor. They do not first have to have gone against the company. They can, with most personal guarantees, the way they're drafted, go directly against the director and say, the company owes us money, we have requested the money, the company has not repaid it, we want you to do, and if you don't, we will bring a court action against you. That is, I suspect we may see quite a lot of those going forward. Now, it's whether the banks decide to try and be more supportive and not go straight against those PGs. But ultimately, the banks are going to be under pressure, whether it's in 9 months, 12 months, or 18 months' time. The banks are going to be under pressure for their money. And I suspect we will see more and more claims for guarantees given 3, 4, 5 years ago. Directors who have given personal guarantees should look to see what those guarantees are. Some guarantees, particularly from the main lenders, tend to have an ability for individuals to be able to crystallize their loss or their potential loss and basically say, that's it, as of today, or I'm giving notice to terminate my liability under the guarantee. That normally takes effect 3 months from when the notice is given, and that then puts a line in the sand for the liability for the director. Guarantees given to the lesser lenders or the new lenders on the block tend to be much harsher and tend not to have an ability to terminate or to crystallize your liability. It's one thing directors should be looking at now. See, you may well think it's a company, it's not a problem. Don't forget that guarantee that you had to give 4 years ago to get your business off the ground. That is still live.
Mm. Shall we skip to the next slide?
Yep.
So I should say we've talked about a few of the provisions that are relevant when we're looking at the risk insolvency poses. There's a lot more. What we've done is taken a section of the most relevant ones as we see fit. But the point of this slide is that it's important to look at what powers the liquidators or administrators have when a company is put into that position. Now, when it's entered a formal insolvency process, there are a number of transactions that can be challenged under provisions of the Insolvency Act. Now, they're generally referred to as reviewable transactions. We've listed a few of them. There are others, but the main ones here are transactions at undervalue, preferences, invalid floating charges. There are also things like extortionate credit transactions, transactions that defraud creditors, and just general circumstances where past directors and shareholders are asked to contribute. We're going to run through those that are listed on the slide. There are also two common law rules which derive from I suppose the core legal principle that a court won't allow an entity to arrange its affairs in a way that frustrates the legitimate interests of creditors in the event of its insolvency. So that's not something that we're going to go into in detail, but it's just worth making the point. If you deliberately structure your corporate arrangements in a way that is designed to frustrate creditors, that could cause problems. So you need to think quite carefully about that. The powers here that we're going to run through, the reason they exist is to make sure that once a company goes into a formal insolvency process, its assets can be distributed amongst all of the creditor pot equally. Now, there are obviously secured and unsecured creditors, and there can be different preferences, but what we're really talking about is making sure that all the assets that the company has legally remain available to be distributed to the creditors in equal proportions. So that's what these powers are geared to achieve, and it's important that you're aware of those because they'll affect you if a company is forced to take these steps. So looking briefly at transactions at an undervalue. An administrator or a liquidator can ask the court to set aside or make another appropriate order in relation to a transaction at undervalue if, for example, a company gifted or otherwise entered into a transaction on terms that it received no consideration, or it entered into a transaction for consideration which in monetary terms or what money's worth was significantly less than the value of the consideration provided to the company. So, for example, offsetting agreeing to give up on a loan, for a sum vastly less than what the loan is worth, could be treated as a transaction at undervalue. Now, this applies if the transaction was entered into during a 2-year period before the onset of insolvency and made the company unable to pay its debts as a result, or at the time the transaction was entered into. So there's a number of bits that need to be proven, but the point here is that in many circumstances, the liquidator has the power to look back in time at the transactions that the company was forced to enter into by the directors, and it can hold the directors to account if the rules weren't satisfied. Now, we've not gone into a detailed explanation of these, and we don't intend to. The main reason for that is firstly time, and secondly because each situation differs. Now, as I said, there are a number of examples, but selling off company assets at below market price, directing the company to agree to supply without payment, for example, perhaps with payment going elsewhere. I said directing the company to write off loans owed, for example, by shareholders or directors. Those sorts of situations, there'd also be a breach of directors' duties, but they'd be caught by these provisions as well. Moving on to preferences. an administrator or a liquidator can ask the court to set aside or make another appropriate order in relation to a preference. Now, what's a preference? Well, a company gives a preference to a person if each of the following things apply. The person is one of the company's creditors, or there are a surety or a guarantor for any of the company's debts or liabilities. The company does or allows anything to be done which puts that person into a position which, if the company went into an insolvent liquidation, will be better than the position they'd otherwise have been in. The company was influenced in deciding to give a preference by the desire to prefer that party. If parties are connected, this is a provision that can be assumed to have existed, and the preference was given during 6 months or 2 years where they're connected before the onset of insolvency, and the company was unable to pay its debts either at the time of the transaction or became unable to pay its debts as a result of it. Now, the overriding point here is that if the company owes Peter and Paul and decides to pay Paul rather than Peter, Paul's being preferenced, and it offends the principle that each shareholder should get whatever is left of the company equally, rather than one getting more than the other. So there's a reconciliation and a power by the liquidators or the administrators to, I suppose, account for or undo those transactions. Really common examples would be repaying loans made by directors or family or friends of directors when they feared the company may go under, because if your duty is to the creditors, you inadvertently preference one over the other. I also see repaying emergency loans made by directors, and the common explanation that, you know, I only paid the money in because the company needed the cash flow. I was desperately trying to keep the company alive. The difficult conclusion is that as soon as you pay the money in, anything that goes out is treated as a preference. So you need to think quite carefully about how and when and what to pay in to help keep the company going in these sorts of circumstances. And we come on to that during the practical guidance section in the next slide. Now, I'm going to say a word on floating charges, and it may be that David has some comments on this too. The short point is that the position isn't straightforward, but in short, there is a provision in the Insolvency Act that provides that a floating charge given by a company is valid only if there's consideration. Now, I think the best way to explain this is if we assume that Director A has already given the company a loan of £1 million on an unsecured basis, and he now wants to grant a further, let's say, 200k facility to the same company. Now, in principle, he can take a floating charge on the company's assets as security for the additional 200k, but were he to try at the time he granted a 200k facility to give a floating charge as security over the rest of the loan, so the 1 million and the 200, he may find himself or herself in difficulty were he to want to rely on that security in the event of a liquidation. It's a point that we flag. The detailed law can be a little involved, so we don't intend to spend significant amounts of time on this bit at the moment. David, I don't know if there's anything you wanted to say.
No, it's one of the first things a liquidator or an administrator will do when they're appointed is to see the validity of floating charges and see whether or not there was consideration given for that floating charge. It's surprising how often it is not given the consideration, and they say, "Oh, it's all right." You know, people just put the charge that they had previously and say that will cover it. It doesn't. It just doesn't work that way. I'm just mindful of time, so just going through loans and dividends. Again, many companies, smaller companies particularly, will pay their directors by way of dividend largely. You can only pay a dividend if you've got profits available to make the distribution, and that's got to be by reference to the relevant accounts. that's the only circumstances in which dividends can be paid lawfully. So paying monthly in the hope that things will turn round, there is a risk if the company goes down that a liquidator or administrator could turn around and say, I want those dividends repaid. And that is a risk for smaller businesses. And those businesses are the ones which, to an extent, have been left behind by the government, because it's very difficult, I would suggest, for those sole director with maybe one other employee businesses to claim any relief under furloughing, because can that director properly cease working for the business? Possibly not. However, if he's only been paying himself a small amount of money and taking the remaining money out of by dividend, even if he was able to furlough, you'd be looking at what he had previously been paying himself as salary under PAYE, and that may not be a lot. And there doesn't seem to be anything to fill the gap for those sorts of companies. And loans, we've touched on. The other thing to be aware of, if shares are issued to you and they have been issued nil paid, and it still does happen, one of the first things that a liquidator or administrator may do is look to recover the amount that should have been paid for those shares. So again, beware, if you've got any nil paid shares, the liquidator administrator could be coming knocking on the door saying, can you please pay up? And Simon, do you want to touch briefly on director's disqualification?
Yeah, it's not something we're going to talk through in great detail. The overriding point is that a court can make a disqualification order against a person that he shall not, without leave of the court, be a director of a company or in any way directly or indirectly concerned in the promotion, formation or management of the company for any period. Now, what you need to be aware of is that during any liquidation or administration process, liquidators or administrators are bound to make a report to the insolvency service that outlines concerns over direct conduct. And breaches of duties can fall within that definition. So there may be a situation where you are faced with a claim by a liquidator for breach of duty that results in a monetary award against you if matters go poorly, and later down the line, on much the same circumstances or grounds, a claim for disqualification in some circumstances. So what we tend to be thinking about is early on, we're looking at the claim by the liquidator, but actually we're also thinking ahead about how we can mitigate against the risk of a disqualification action being made. And this is something that's becoming increasingly common. So it's just worth being aware, and prevention is far better than cure in these sorts of circumstances. I don't propose on going much further. The only thing we didn't talk about was section 127, which is void distributions. This really deals with circumstances where after a winding up petition has been presented, one needs to be very careful about what the company does and what money is paid, because it's effectively on notice that it's insolvent. I don't think it's necessary to go any further than that for the moment. So we can probably just turn to the practical guidance.
Yeah. I think we can go. Sorry. I think there's a couple of questions which I think we'll deal with because we're I think one of the questions I saw was, would the obligations of an accountant who is a director be higher than the obligations on other directors? From a financial point of view, it's not so much that the obligation is higher, it's that he is expected to bring more to the party. So in assessing whether or not he has been exercising his duties properly, he will be expected to bring more than, for example, a gardener who is the director of a company who has not got financial knowledge. So to that extent, there is a higher expectation of that director whilst when looking at the numbers. Have you got anything else, Simon? Do you want to say on that?
No, I think in short, every, I think as you probably alluded to, every circumstance tends to be treated on its merits. Simply because one person is professionally qualified rather than the other doesn't automatically mean that they'll be more or less culpable, but you do look at their ability and their role within the organisation. And of course that can have an impact. So I think it's going to be quite situation specific.
And we'll deal with the other Q&A that was asked, which is an interesting one. What are the top 3 steps directors can take now to protect themselves, help their business resilience, and hopefully avoid insolvency? Top 3 steps to protect themselves, help their business resilience, and avoid insolvency. Simon, do you want to do it, or do you want to?
Well, I think the first thing is to make sure you're aware of the wider risks, and you know, that's really the aim of today. Understanding I suppose the ships on the horizon, being able to see them gives you a far better chance of avoiding them. I'd say if you're concerned, take advice, whether from an accountant.
Yeah, I agree. It's
whether from an accountant or an insolvency practitioner, it gives you that extra layer of fallback to sort of justify what you're doing. Make sure that you document your decision-making process, and I would probably look at putting your house in order. So, you know, looking back in time, you know, to what extent are there dividends paid in circumstances where they fall outside an accounting period? Are there personal guarantees that should have or could be given up? Is the company in a cash position? You know, that's really a difficult question to address now. But I think those would be the points I would take. We're going to run through some practical guidance just on the last slide, I think. But David, is there anything else that you?
No, that's that. I think that's it. It's taking the advice, listening to the advice, acting on it, and documenting it to protect yourselves as directors. It's so important that you document it so that you can show, if the worst happens, that in 12 months' time, you can show back on the 7th of April, you did consider it. Here's everything we went through. Here's the papers that justified the decision then. It's going to be so much easier if you've got those in place now when you make that decision, rather than trying to persuade someone in 12 months' time. Honestly, you know, at 3:30, I did consider all these things. I just didn't write it down.
Mm. Yeah. David, do you want to run through some of this?
Well, it's just, of course, we've done them to extent. Check directors and officers liability insurance if you've got any. Query whether you can get it now. Evidence your decisions. Rectify the issues which we've discussed, really. Be aware of your duty to creditors. If you are insolvent, remember that you've got to look to the creditors as a whole rather than the members. Simon mentioned it before about taking advice before injecting funds. As soon as you put the money in, don't assume that you're going to get it out easily, even if it's in by way of loan. And assume, because it's the safest way, that you will be challenged. You may not, but assume you will, so prepare for it and have all the paperwork there. And Simon, do you want to deal with the last one about winding up?
Yeah, I think the big point here is just be aware that if your company is served with a winding up petition, don't ignore it. It usually follows non-payment of a statutory demand, but once you are put on notice that somebody is intending to wind the company up, and I should say the most common is HMRC, and at the moment there's a holiday period effectively during the sort of present circumstances. So that may have an impact. But if the company is presented with a winding up petition, don't ignore it. If the business needs to make payments to suppliers, or whether it's direct remuneration, possibly, there is a facility to apply to court to validate those payments. If you continue on making payments to essential suppliers as usual, there is a significant likelihood that those will be scrutinised and possibly challenged later down the line. It's far better if you need to make payments, or you envisage that any payment you make is going to be challenged. Getting validation from the court puts you in a far greater or stronger position later down the line. It can be possible to do that retrospectively, but it's much harder.
Well, then I think that's it, because I think it's the question and answer slide, the last one, and we're out of time anyway. I suppose just a couple of thoughts that I had on top of this. That slide was headed "The World's Today." I'm thinking about the world tomorrow. When we come out of this, the question is, how quickly will the economy recover? And if furloughing goes, if the ability to pay your VAT late goes, don't forget, apart from furloughing, most of the gifts from the government actually aren't gifts, they are loans. They will have to be repaid. If you're deferring your VAT, it will have to be repaid. If you're deferring your tax, it will have to be repaid. And I think that there's going to be a period after we come out and the restrictions are lifted. I'm not sure the economy is suddenly going to take off again straight away. And that could be the stage when people have got to think hardest and possibly take the hardest decisions. If furloughing is no longer there, what are you going to do with your employees? They've got to come back onto your books, so to speak. Can you afford to pay them? And don't forget that when we do come out of this, you do have to look forward and still consider whether or not you're going to move forward. You may have taken on a lot more debt if you're able to get the business interruption loan. How is that going to be repaid?
Yeah, I agree. I think it's very much worth thinking about how this all plays out, because there is nothing that's free, and it sort of plays into the decisions that you as directors will be making. Is it reasonable, if the company is in financial difficulty, not to take a loan that seems at face value to be very, very good in a term sense? You just need to be in a position to explain, preferably with contemporaneous minutes or the documentation, why it was that you made the decisions that you made. And I think once you start thinking in that way, it will put you in a far greater and stronger position going forward.
And just particularly one thing to say, sorry, the other one thing, I'm mindful of time. One of the questions I've considered is, should directors just resign? Now, the board of directors should be acting collectively. On that basis, you should be having regular meetings, weekly meetings, possibly daily meetings, looking at cash flow. Just jumping ship because you're unhappy with the way things are going. If you're dissenting and everyone else goes against you, that's possibly reasonable. But it doesn't relieve you from liability for wrongful acts or omissions which took place during their term of office. And equally, directors who do resign could be criticised for abrogating their duties and responsibilities at the time when the company's creditors and stakeholders needed them most. So just jumping ship thinking, I can avoid all these liabilities, is probably not the answer.
Well, David, I don't think I have anything further to add.
David, do you want to say
anything? No, well, I think it just falls to us to say thank you very much to everyone for tuning in. It's a pleasure for both David and I to be here and to be able to talk to you. So thank you very much for listening to us. We're very happy to handle other questions offline if anyone wants to talk about particular situations. Our contact details were up on the screen, so hopefully you're able to pick those up. Yeah, thank you again.
Yeah, thank you.
And may I say, Simon and David, thank you so much for joining us. I've thoroughly enjoyed listening to you and learning more about directors' responsibilities. For all the participants out there, this is part of the Thames Valley Chamber of Commerce COVID-19. I suppose it's really a survival pack, and we're particularly grateful for BP Collins for sharing their expertise, and I'm sure we'll be hearing from the team at BP Collins in future webinars, because they really are excellent and such fantastic chaps as well. So thank you, David. Thank you, Simon, for joining us, and we look forward to hearing from you again.
Thank you.
Thank you.